give a incentive to the dealers that if you give 10 million worth of mortgages, we will give you a commission of 5%. But if you give 15%, then on the if you give 15 million,
you get 7%.
On the complete 15 million, you will get 7%. And if you go 25 million, it might be 10%. So in that case, it is difficult to demonstrate whether it is linked to a specific contract. And we used to say that because it is not linked to a contract, you need to expense it immediately.
Yeah. And that's one of the issues with the EIR calculation.
The same thing applies over here now with 15 also. Is it the same?
Well, you say
here also you are mentioning that it should be linked to a specific
correct.
contract.
Well, so basically, if you have so what you're telling to me is the commission is, let's take a non-banking, because IFRS 15 is more for non-banks. So you sell 10 cars, you get a 5% commission. You sell 20 cars, you get a 15% commission. Or let's say it's a service, so it's spread out over time. So I guess your question is, what do you do? Well, if they've only... Well, I think you would still use the estimated commission. So if you expect the salespeople to hit a commission that's going to be a composite rate of 6%, you would use 6% as your commission cost.
Will we be able to demonstrate that it is linked to a specific contract?
I don't think
in that case, it is not linked to a contract.
I don't think you have to, because if you just go back to the principles here, when you do your cost estimation in IS2 and generally, it's based on your best estimate. So if the commission is incremental, the estimate is they're going to get a composite rate of 6%. Some get 5, some get 7, and your composite is 6. So I would use the composite rate as the estimate. It's incremental. It's an estimated incremental cost because it's a tiered slab.
We actually got the incentive plan changed because we said that it can't be linked to a contract. It won't be possible.
Yeah, I mean, I think that the key here is it's not a period. It's not a period cost because it's not a salary. It's linked to a sale. So if it's a variable amount, you estimate the variable amount, and if it's a step-up commission, you use the best estimate. So that's a good question there. I'll write that one down as well. Any other questions up to here? Say that again, please.
Does that mean that all the commissions are that are linked to the performance are a separate contract?
No, I'm not saying that they're a separate contract. What I'm saying is they're not a period cost. They're going to be booked as an expense when you book the revenue. So if you're selling a service and the revenue is over 24 months, the commission is amortized over 24 months. If it's a product and you book the revenue on day 1, you book the commission on day 1. So the commissions or the variable...
Even though the commission is not paid to the people.
Well, who's it paid to then?
I mean, saying that the commissions are not get paid, right?
Payment's irrelevant in IFRS, right?
Yeah,
It's accrual basis.
Yeah, but even if the payments are... we're not sure that even the salespeople will be able to fulfill that sales target. Even considering that, we book the commission on day 1.
So, okay, let's say, for example, that you get no commission unless you've done 10 sales. But they've done 1 sale. And you expect them to hit the target. You need to book the commission for the 1 sale, even though they haven't hit the 10 yet. So the question is the commission on the 1 sale, is it incremental or non-incremental? It's incremental, because the commission is only payable if the sale happens. Therefore, if it's incremental, when you book that commission, it hits the P&L at the same point in time the revenue is booked. They get a salary. They get a fixed salary. If you sell nothing or a lot, you get a fixed salary. The fixed salary is expensed every month, irrespective of when you make a sale. That's the gist of the standard. So fixed salaries are costs that are not linked to the sale happening, so whether it's a yes or a no, those costs are expensed when incurred.
So if the sales target says that we live after a year sold 10 more units, so if we booking the commission for the 9 units, and the 10 units never sold.
That's a change in estimate.
So the commission that I paid for the 9 units, that will be reversed?
Correct. It's a change in estimate.
I think this should be looked into on an aggregate basis, that on the aggregate basis, whatever sales we have made during the year and we have recognized 40% of those contracts as revenue, then all the incentives that have been accrued or paid during the year, 40% of that should have been expensed out, rather than on an individual basis.
Yeah. You do these usually. It's on. You can do these on an aggregate basis. Some sort of estimation. So we spoke about this yesterday, right? Contract assets, contract liabilities. Happy with that? Yes. Okay. And here's another thing that's changed is principal and agent. So what has changed now that we don't care about credit risk? So in the old IAS 18, credit risk was a key factor. The emphasis of a principal versus an agent is now all about who controls the specified goods or the service prior to delivery. So it's a different model than before. We have these factors such as inventory risk, the discretion to set prices, and the primary responsibility, but the overarching principle who controls the promised goods or services. This is a big issue for telecoms. I have a question in the notes, but it's a bit long, so I'll just talk you through it for a second. So in the telecom industry, they sell phones two ways. There's a direct channel and an indirect channel. The direct channel means you go into a store that's owned by the phone company. So I go into a Vodafone shop owned by Vodafone. And I go into that shop and I get a phone and a service. How many POs do I have? 2, right? I go into another shop, it says Vodafone, it looks like Vodafone, but it's owned by a third-party agent. As a customer, you might not even know the difference. And when you sign a contract, in the fine print, the contract says that so-and-so is an agent of Vodafone. So I go into another shop, it looks the same, it smells the same, I sign a contract. How many POs do we have now? 1. So the problem that the telecoms are having, if you buy from the direct channels, you have revenue today from the phone sale and revenue tomorrow from the service. But when you buy from the agent store, there is no revenue today because the agency is reimbursed for the loss on the phone plus a commission. And from the phone company's perspective, there is one performance obligation to provide the service. Does that make sense? No. You didn't follow me?
No, I didn't follow you.
Okay, if you look at the handouts for a second, just look at the last question there. Question 7. So it's question 7. question 7. Now be more clear, right? It's cooler today. I told them to turn the AC up. Have you read it? You're in the wrong question. 7. Have you read it? Yeah. All right, so have you read it? So the issue here is you recognize revenue when you satisfy the performance obligation, right? Now, if you're a phone company, if you speak to the CFO of a phone company, they will tell you their perception is the loss on the phone is a business decision to get phone customers. That's how they think. So they were a little bit upset with this standard because what they're saying is, if I sell a phone in my shop, it's going to affect my margins and how I report differently than if I sell a phone in a third-party shop. So if I sell a phone, what happens is we always sell the phone at a loss. That's common practice in the telecom industry. So I can't remember the numbers here. They sell the phone for $150. It costs 800 euros from Apple. So they lose 650 on the phone. They don't lose 650, they get it back somewhere else, right? But that's how the CFO thinks. We lose 650 here, we get a customer, and we make the money by having the customer. They call it a customer acquisition cost from a management accounting perspective. So the point is, if you buy a phone in my store, and I'm the phone company, I will book revenue today and profit today. But if you buy a phone in a store from my retailer or from my third-party vendor, I book no revenue today and everything is deferred. And the problem that the phone companies have is they view these as distribution channels, and they're a little bit unhappy that the distribution channel impacts when you recognize the revenue. Does that make sense now?
So why selling through a distributor is different? Because in this example, the distributor is also purchasing mobile phones.
But in this case, the phone company doesn't sell the phone. The phone company has one performance obligation to provide a service when you use a third-party store.
I think both ways, if they are selling directly.
Hold on. The phone comes from Apple. And what the standard says on principal versus agent is who controls the phone before it's given to the customer? The shop. So, number one, the phone company is not a principal in the transaction. They don't sell the phone. All that the phone company does is sell the service. And in my example here, the way it worked with my client is what happens is the phone company would go to Apple, say, if my vendors give the phones to them and give them my same price, and they use those phones for my contracts. This is how it works from a commercial point of view. But at the end of the day, the phone company is not a party to the transaction to sell the phone. Therefore, the phone company has one performance obligation, the service. And because the service is done over time, there is zero revenue on day one.
But their service requires them to sell the phone.
Yeah, but the point is, who sells the phone? An agent. So from the phone company's perspective, from Meteor's perspective, their only obligation is to provide the service.
Because you're saying that the agent has the inventory risk over iPhones they are selling.
Inventory risk is not the key factor. They control the promised good. In other words, they get the phone from Apple. So you buy the phone from Apple, you pay 800 euros, you give it to him for 150, I'll give you 650 for the loss, plus I'll give you a commission. And I'll make my money on his monthly bill. That's my business model. But from my point of view, I have one deliverable, the service. That's it. So it had a huge impact in that particular industry. Does that make sense now? So what's changed is we don't care about credit risk. IAS 18 we did. We care about who controls the promised good or service before it gets delivered to the client. So control is the key. If you control it, you're the principal. If you don't control it, you might be the agent. And if you're the agent, you would book just your commission. So again, what's changed is credit risk is removed. I'll skip the transition guidance because IFRS 15 was last year, right? So you should have transitioned by now. Or you're late, right? Any questions on 15? Correct.
They won't record the invoice.
Correct. And the phone company, in my example here, gets no commission on the phone.
The phone company receive payment on the data payment, not on monthly invoices.
Correct.
Monthly invoice. So there is no loss in that case.
Correct, but the
amount in equal installment of next year.
correct. Overall, they make money. The way they think is I lose on the phone, I make on the service.
But for the accounting statement, there is no loss.
No. But what we would do is take the loss of the subsidized amount on the phone to the agent. That's capitalized. That's a cost. That's a marketing cost, and it's amortized over the contract period.
That is a contract asset. Additional amount to obtain the contract.
The amount to obtain the contract would be a contract asset, yes. It's a contract asset. So a contract asset doesn't have to go to cost of goods sold. A contract asset could also go to SG&A as well, correct. Is your question clear now? Any other questions?
In the example that we looked at, Meteor Telecom,
Yes.
the reimbursement that the phone company is doing to the agent for the loss on iPhone,
Correct?
that's going to be what, an incremental cost?
Yeah, that's going to be one of these. That's going to be a cost to obtain a contract, capitalized and advertised over the period when we earn revenue.
But that would go, again, as part of selling.
SG&A. So it's a contract asset. When it's released to the P&L, it hits as an SG&A. Any other questions on revenue?